the organization whose entire job is to promote gold, just issued a warning. They said there's a You know that feeling when everyone around you is making money and you're the only one not in on it? That's what gold feels like right now. Your uncle's texting you screenshots of his portfolio. Reddit's going crazy. But here's what nobody's telling you. The last time gold moved like this, I mean exactly like this, was 1980. And what happened next? A 65% crash that took 28 years to recover from. I'm not saying history always repeats, but I am saying it rhymes. And right now, gold is singing the exact same song. My name is the Finance Professor, and I spend way too much time analyzing markets and trying to figure out why everyone loses their minds at exactly the wrong moment. If you've been wondering whether you should buy gold, sell gold, or just ignore this whole thing, stick around, because what I'm about to show you could save you from making the most expensive mistake of your life. Let me show you something that should terrify you. This is gold's price action over the past 18 months. And if you know anything about markets, you know what vertical lines mean. They mean the end is near. Gold has gone from $2,000 to $5,300 in basically a year and a half. That's a 165% gain. Here's some perspective. The S&P 500 just crossed 7,000, and everyone's acting like that's insane. But over the same period, the S&P is up about 35%. Gold is up 5 times more than that. And here's the thing that keeps me up at night. Every single vertical move in history, and I mean every single one, has ended the same way, with a crash that wipes out everyone who bought at the top. The dot-com bubble, Bitcoin in 2017, housing in 2007, GameStop. All of them looked like this. All of them had the same narrative. This time is different. And all of them collapsed. Look, gold has been a store of value for 5,000 years, but that doesn't mean it can't crash. Actually, scratch that. It will crash. The only question is, when? Let me take you back to 1980. Gold went from $35 an ounce in 1971 to $850 in January 1980. That's a 2,300% gain in less than a decade. People were convinced it was going to $2,000, $3,000, maybe even $5,000. Sound familiar? The narrative was identical to today. High inflation, geopolitical chaos, loss of confidence in the dollar. And then, nothing. Gold peaked at $850 in January 1980. By 1982, it had fallen to $300. By 1999, it was at $252. If you bought gold at the top in 1980, you didn't break even until 2007. That's 27 years of waiting just to get your money back. The people who lost everything weren't idiots. They were smart investors who looked at the same data we're looking at today. They were wrong. And I'm watching the exact same setup unfold right now. So what's driving this rally? Number 1, central bank buying. In 2024, central banks added over 1,000 tons of gold to their reserves. But here's what nobody mentions. Central banks are terrible at timing. They bought gold at $1,900 in 2011, right before it crashed to $1,050. Central bank demand is a lagging indicator. By the time they're buying, the smart money is already selling. Number 2, the fear trade. The Middle East is on fire. Ukraine is a mess. The argument is that gold is the ultimate safe haven. But markets are forward-looking. What if a peace deal gets signed? If there's a surprise ceasefire, the risk premium in gold analysts estimate hundreds of dollars, evaporates overnight. And you're not looking at a slow decline. You're looking at a 10% gap down in a single day. Number 3, inflation protection. But inflation in the US has been falling for the past year, down from 9.1% to around 3.5%. If inflation keeps falling and rates stay high, why would you hold gold earning 0% when you can hold a treasury earning 4.5%? You wouldn't. And institutional money will rotate out of gold and into bonds. Fast. Here's the part that should really scare you. The World Gold Council, the organization whose entire job is to promote gold, just issued a warning. They said there's a legitimate risk of a 20% crash in 2026. Let me repeat that. The World Gold Council is warning about a crash. Their scenario: if U.S. economic policies spark stronger growth, investors will flee gold for high-growth stocks. That makes perfect sense. The S&P 500 just hit 7,000. AI stocks are printing money. If you're sitting on 100% gains in gold, why wouldn't you rotate into growth? But there's another angle nobody's talking about: gold ETFs. Most of this rally has been driven by ETF inflows. Retail investors piling into GLD and IAU, chasing performance. But ETFs are forced sellers when redemptions hit. If we get a single day where gold drops 3%, it triggers panic selling. ETF managers liquidate holdings to meet redemptions. That creates a feedback loop. Selling begets more selling. A small dip becomes a 25-30% crash in weeks. We saw this in oil in 2020. Oil went negative because of ETF liquidations. Could gold crash 40% in a month? Absolutely. I've identified 3 specific catalysts that could pop this bubble. Trigger number 1. The Fed's hawkish hold. The market is pricing in 150 basis points of rate cuts. But what if the Fed doesn't deliver? If inflation stays sticky and the Fed stays put, the opportunity cost of holding gold becomes unbearable. Gold earns 0%. Treasuries earn 4.5%. That's a massive gap. The moment gold stops working, institutional money is gone. Trigger number 2. Geopolitical peace deals. What if there's a surprise peace agreement in the Middle East? What if Ukraine and Russia sign a ceasefire? A huge chunk of gold's premium, hundreds of dollars per ounce, is purely a risk premium. The moment that fear evaporates, so does the premium. Gap down, overnight, while you're sleeping. Trigger number 3. ETF liquidations. When the tide turns, redemptions force managers to sell. Selling pushes prices lower. Lower prices trigger more redemptions. It's a death spiral. In 2013, gold crashed 28% largely because of ETF outflows. This time, with retail massively overexposed, the crash could be even worse. There's a psychological phenomenon most people don't understand. When gold hits $5,000 or $5,300, it creates a natural ceiling. Because everyone who bought at $2,000, $3,000, or $4,000 is now sitting on massive profits. If you bought at $2,500 and it's now $5,300, you've doubled your money. Are you really going to risk giving that back? Of course not. You take profits. When millions make that same decision, you get a supply surge. This is how bubbles pop. The marginal buyer is gone. Only sellers remain. And here's the killer. The stock market is ripping. Your friends are making 40%, 50% on AI stocks. You start thinking, maybe I'm in the wrong trade. This is FOMO. And when enough people liquidate gold to chase the stock rally, it creates a liquidity-driven crash. We're already seeing early signs. In the past month, while the S&P surged, gold has been flat. That rotation is just beginning. When it accelerates, gold gets crushed. If you own gold right now, you have 3 options. Option 1, sell everything and get out. Lock in your gains. Walk away, sleep well. If you bought at $2,000, you've doubled your money. That's incredible. Take it. Don't be greedy. Don't be the person holding the bag. Option 2, reduce your position. Take some profits. If gold is 50% of your portfolio, trim it to 20%. If it crashes, you're not wiped out. If it keeps going, you're still in the game. Option 3, hedge your position. Buy put options, short gold futures, use inverse ETFs. But don't just sit there and watch gold crash 30% telling yourself it'll come back. Maybe it will, but you know what won't come back? The last 10 years of your life. If you're 35 and gold crashes, by the time it recovers, you'll be 45 or 55. Are you willing to bet a decade on gold bouncing back? Look, wealth isn't built by buying at the top. It's built by knowing when to walk away. The smartest investors aren't the ones who made the most money. They're the ones who kept the most money. Right now, every indicator is flashing red. World Gold Council warning of 20% crash, Fed staying hawkish, geopolitical risks, peaking ETF inflows, slowing stock market pulling money away. So ask yourself, do you want to be the person who ignored all of this, or the person who saw it coming and got out before everyone else? The choice is yours. If this opened your eyes, smash that like button. Subscribe for more videos breaking down what nobody else is talking about. Drop a comment. Are you holding gold, selling, buying more? I want to hear from you. Thanks for watching. I'll see you in the next one.